welcome to this today's exciting panel discussion. The reserve and the rails, Bitcoin powers, stablecoins utility. I mean, this is an amazing place to have a panel discussion. I mean, we get the view of gardens by the way. What else you can ask for? So, okay, let's start with introductions.
Like if you look at the blue chip DeFi protocols, right, they've been battle tested, but there's been many hacks and exploits. And especially when institutions are deploying Bitcoin in size into DeFi, they want additional layers of assurances.
Demand for stablecoins rising at the same time as demand for Bitcoin, because stablecoins have become a means for large players, including institutional players, to purchase the asset that they really want to hold.
You borrow stablecoins against your Bitcoin. Then you now have the stablecoin to do whatever it is that you have to do, right? So again, it's not a mutually exclusive, but quite a complementary solution to our clients. It's super interesting what happened in the US with Trump pushing forward all the crypto assets, regulation in favor of crypto. That's super interesting. And on the contrary, what we have in Europe, it's a total disaster.
So for stablecoins to be sustainable, their backing models matter. So what structures, fiat, Bitcoin, or mixed reserve, do you believe will define the next generation of stablecoins and why? I'm your host, Khushboo, Khullar, venture partner at Lightning Ventures. So Lightning Ventures is a US-based VC firm. We invest in Bitcoin companies. Till now, we have invested in 40 plus Bitcoin companies. And so if you're building something groundbreaking in Bitcoin, do reach out to us. We also have a crowdfunding platform where even non-accredited investors can also invest. So let's start with the, okay, in this order, but it's fine. Let's start with you. Let's have a quick introduction.
Hello, it's a pleasure to be here. My name is Eneko, and as you can tell by my accent, I'm from Texas. Okay, no, I'm originally from Spain and now based in the UAE. I'm the co-founder of Hong Kong-based Stabolut, which is a multi-currency yield-bearing stablecoin company.
Okay, let's move on to Kelvin. And I guess, okay, so Kelvin is from HexTrust. In fact, last month I met Alicio at the panel and we discussed about micro and macro forces for adopting institutional Bitcoin adoption, in fact. And now we have Kelvin here. So Kelvin, just give a quick introduction about you, how you come into this ecosystem in this space, and also about HexTrust.
Yeah, great. Thanks for having us on stage. My name is Kelvin Shen. I'm Chief Commercial Officer at HexTrust. Been in my role now for 6.5 years and then continue to build. My main responsibility is to help create bespoke solutions to help bring institutional investors into the digital asset world. And for HexTrust, we started the company back in 2018 in Hong Kong. We're licensed here in Singapore, holding an MPI license, Dubai, Nevada license, as well as a license in Hong Kong as well. Really focusing on custody, staking, OTC execution, and structured products for our clients around the world.
Okay, let's move on to Luke now.
All right. Hey, everyone. Luke Xie here, co-founder of SatLayer. So we're very much focused on building the economic layer for Bitcoin, given that it is clearly becoming the next global reserve asset. And so how we do that is by leveraging restaking as the leading Bitcoin restaking protocol. But I think the differentiator for us is really focused on real economic yield use cases like Bitcoin-backed insurance, taking Bitcoin-backed liquidity floats, as well as working with some of the leading players in RWA, AI, and stablecoins. Happy to go into that later. And then we're also the exclusive restaking partner of Sui, Babylon, and Berachain.
Thank you, Luke. I know Bitcoin OS for quite a while, but for our audience, Edan, if you can let them know what Bitcoin OS is.
Sure, thank you. I'm Yago. I've been building in Bitcoin now for 14 years. Among other things, I helped set up one of the first remittance companies using Bitcoin. I helped found Sovereign, which was the first project which pioneered DeFi for Bitcoin and is still today the largest ecosystem of Bitcoin DeFi. And for the last few years, I've been working on what to me is the most exciting thing that I've been working towards effectively for the last 14 years and finally has become possible, which is BOSS, Bitcoin OS. We're building a operating system into Bitcoin, allowing Bitcoin itself to become fully programmable so that it can be a settlement layer for any asset, so that people like myself, like everyone here, will be able to do more with their BTC. And what we've now been seeing is particularly a great deal of interest from institutional holders of BTC who want to be able to utilize Bitcoin as a counterparty asset to generate yield through their custodians or through their own self-custody. In other words, for the first time, institutional Bitcoin DeFi.
Okay, thank you, panelists, for the introduction. So let's dive into the discussion. Let me start with Edan. So you have said that Bitcoin is the ultimate reserve asset. So in a world where stablecoins dominate transactional activity, how can Bitcoin's monetary property remain the anchor while still enabling the utility of stablecoins?
Sure. So if you look at what we've managed to create in the crypto space that is of real utility that people are using every day, the biggest thing is obviously Bitcoin. $2 trillion in non-governmental asset, an asset that can be held without counterparty risk and represents a hedge against any third party doing something that you don't want or that you cannot trust, right? And so it's become this incredibly important asset. The second most important thing are stablecoins. And stablecoins have become a medium of exchange, a way of transacting globally without borders in a digital world. These two things represent very different parts of the value chain. Bitcoin is a long-term asset, and it is there to provide you with property rights. It's there to protect your finances over the long term under different circumstances. Stablecoins, on the other hand, provide liquidity. They provide access to exchanges, transactions between countries, and more they're being used for remittance, commercial transactions, etc. So sometimes people think about Bitcoin as money and think that Bitcoin is competing with the dollar or with stable coins or other forms of money. But in practice, Bitcoin is a money, but not a currency. It's a non-currency form of money. It's what's known as commodity money, something we haven't really had in the world for a long time. Whereas stablecoins are very clearly a currency type money. And when you're in stablecoins like the US dollar, you're tied very, very clearly to the dollar, right? The United States government now is racing towards $40 trillion in debt, right? It's becoming increasingly worrying. And so what we're actually seeing is demand for stablecoins rising at the same time as demand for Bitcoin, because stablecoins have become a means for large players, including institutional players, to purchase the asset that they really want to hold, which is Bitcoin. So effectively, Bitcoin is the engine here, and stable coins provide a 24/7 means of liquidity around this ecosystem, which is powered by Bitcoin and effectively extends to the entire crypto space. Bitcoin is like the center of gravity. Bitcoin goes up, everything goes up. Bitcoin goes down, everything goes down. And then all of the rest of the stuff that we've constructed is a liquidity or access layer to Bitcoin.
Yeah, I completely agree. I mean, if Bitcoin goes up, everything goes up and vice versa. So since we are discussing stablecoins, I want to pose the next question to you. So since existing stablecoins like USDT and USDC dominate the market, so what shortcomings in their model is Stabolut solving? And how do you see your approach complementing Bitcoin's reserve strength?
So yes. So first of all, it's interesting that the Bitcoin was invented to overcome the problems in the traditional financial system. So Bitcoin was a way for people that live in Venezuela, Turkey, whatever, to avoid the local currency that had hyperinflation, whatever. But at the end of the day, that as Bitcoin was so volatile, people started using stablecoins in US dollars. So that's why now in these countries like Argentina, Turkey, so up to 30-50% of the population are familiar with wallets and they use stablecoins or whatever. So that's interesting, and that's why the use of stablecoins is growing in these kind of countries. So in what we see is a clear trend. So it's not only myself. Also, J.P. Morgan says that yield-bearing stablecoins could capture up to 50% of the stablecoin market, which is very interesting. So there are now more and more yield-bearing stablecoins. USDC, USDT don't give you anything. So we believe, and as same as JP Morgan, that people are going to start switching to yield-bearing stablecoins. On the other hand, it's interesting that 99.9% of the stablecoin market is in US dollar denominated stablecoins, which doesn't make sense when more than half of the world's economy happens in currencies other than the US dollar. 53% of the SWIFT transfers happen in currencies other than the US dollar. So there is here an anomaly and there is an opportunity. And that's why we are launching also stablecoins in other currencies. So we believe that there is an opportunity for multi-currency and yield-bearing stablecoins, and this is what we are doing at Stabolut.
Okay, wonderful. So, Calvin, from the HexTrust point, how do clients balance holding Bitcoin as pristine reserve collateral versus using stablecoins for settlement and liquidity? So, what does that tension look like in practice?
Sure. So actually, the whole Bitcoin for reserve asset and stablecoin for liquidity, it's not, they're not, mutually exclusive, right? In fact, there's use cases for both. So for example, we know Bitcoin, the rhetoric is storage of value. That still remains true. So usually companies, institutional investors use that as the anchor portfolio to hedge against inflation, as an example. Obviously, stablecoin, provides liquidity and so forth. So again, if we separate the two things, what do we have? Starting with the Bitcoin side, and these gentlemen are certainly the expert on this, but we're super excited about this whole Bitcoin Fi rhetoric. Why is that? Because traditionally we say Bitcoin is just digital gold. Okay, gold, you think about that in vaults and it stays there and collect dust, and that's it. And that's great for the first, 15 years of its existence. Having said that, now with innovation, technological improvements, clients' demand also increases. Meaning, just last year, they finally decided to enter into Bitcoin via spot ETF, right? Baby step. We obviously been here probably a lot longer than they have, but they're here. Fantastic. The next step is they want utility from Bitcoin. Okay, so it's using technology, whether it's staking, restaking, borrow lending. Our clients, they want utility. Gone are the days of just buy and hold and let it just sit there. The majority of our clients are asking, hey, HexTrust, can you generate some yield from this? Can I borrow against the Bitcoin that I have in custody with you? Can you give me some rewards for various strategy, whether it's options or basis trading or whatever, right? They want all of that while retaining and making sure that the BTC is safe. And this is why they come to us as a custodian because, well, guess what we do? We do a very good job at holding assets in a safe and secure and regular environment, right? And that's really our narrative on the whole concept of CDeFi is, we're not against DeFi, but we really believe that large institutional clients, or I'm talking traditional, when they want to come into our space, is through centralization than to decentralization. That's the path through a centralized and licensed platform like ours. Now, on the other side of the equation is stablecoin, right? So as mentioned already, stablecoin, needless to say, is going to change the future of money. It's cheaper, faster. There's no reason not to use and change the status quo. We know that already. So our clients, again, same thing is, again, not treating this as a substitute to Bitcoin. A simple example would be, you borrow stablecoins against your Bitcoin. Then you now have the stablecoin to do whatever it is that you have to do. right? So again, it's not a mutually exclusive, but quite a complementary solution to our clients.
Thank you, Kelvin. Since you mentioned about BTC safety, I would like to pose a question to Luke. So like one of SatLayer's major use cases, BTC-backed insurance. So my question is, what unique advantage does Bitcoin collateral bring to insurance market compared to fiat-based or other collateral assets? And how do you see risk models evolving around Bitcoin?
Great question. So I think, as was just touched on, right? I think when users, clients, LPs think about Bitcoin and Bitcoin yield, they take a very different mindset than, let's say, for example, a Solana user, right? Risk is first and foremost, and then yield follows that. Because I think, everyone now recognizes the value that Bitcoin brings. And so, yes, people want more Bitcoin and yield on Bitcoin, but they want to do it in a safe and risk-adjusted way. So that's I think a lot of the insights that we've had from our own LPs, right, who are some of the biggest miners and institutions in the world. And that's where we kind of started focusing on this Bitcoin-backed insurance product. Because, from the TradFi side of things, right, insurance is a very common product, right? Every business gets different types of insurance to cover for different types of risks. And so there's no reason why we shouldn't have the same in crypto, right? Even though I think if you look at the blue chip DeFi protocols, right, they've been battle tested, but there's been many, many hacks and exploits. And especially when institutions are deploying Bitcoin in size into DeFi, they want additional layers of assurances. And so that's why we've been developing this Bitcoin-backed insurance product, because, the way insurance works, if the risk and the risk asset is in a different denomination than the insurance collateral, it gets tricky, and you have what people insurance call foreign exchange risk, right? So that's why we want to have Bitcoin collateral that's insuring Bitcoin related risks, right? Whether it's, slashing risk, smart contract risk, whatever I think the end user actually ultimately wants to secure. And so that's where I think it's super interesting, especially with, the conversation we've all been having, right, about Bitcoin, I think becoming the next global reserve asset, that it makes sense to really build, I think, all these additional products around Bitcoin so people, especially in size, right, can get Bitcoin yield safely.
Thank you, Luke. Let's move on to Eden again. And so my question is, Bitcoin OS is advancing programmability for Bitcoin. How do you see this unlocking new forms of stablecoin liquidity and settlement rails? And what risk does programmability introduce to Bitcoin's role as reserve?
So I think those are two separate questions, right? One question is about stablecoins. And what we're seeing right now is two things. First of all, there's an interest, now that we're making the technology possible, there's an interest into bringing stablecoins directly onto the Bitcoin network, and then through that into other networks which are being connected and deeply integrated with Bitcoin. So Bitcoin rollups, UTXO systems like Cardano and Litecoin. This is extremely important because not only does Bitcoin have the largest network effect in terms of retail users, it has by far, 95% of the network effect for institutional users. And if you're looking to transact in a way where the assets that you're transacting on can be trusted, the gold standard is Bitcoin. I think even more exciting than that is the ability to start using Bitcoin not just as collateral to borrow different kinds of stablecoins, but to use it as collateral to issue stablecoins that can generate yield and that do not expose you to the risks of a centralized party like Tether, like USDC. And so we've now seen the emergence of the first Bitcoin-backed stablecoins. There's several $1 million in Bitcoin-backed stablecoins that have been issued so far. Sovereign is the leading project doing that with the sovereign dollar. And not only are people who are utilizing that getting a stablecoin which is truly protected from counterparty risk, but they're also be able to generate yield through the Bitcoin collateral that they hold. So I think the second question that you were asking is, does this introduce new risks to Bitcoin? And I I think the answer is Bitcoin is fundamentally different from all of these other systems that we've built in crypto. I think in some ways it's unfortunate how different Bitcoin is. Because if you think about Bitcoin, its code base has stayed basically the same for the last 16 years and will continue to stay the same for the next 20 years and 200 years. Its code base has remained simple. There are many people in the world who understand the entire Bitcoin code base. And so when we have been building programmability into Bitcoin, we've managed to find ways to do it without changing any of the properties of Bitcoin. And so I refer to Bitcoin as permaware. It's something new. Software is constantly being upgraded and constantly being changed. Bitcoin doesn't behave like software. It behaves like permaware. And so in that respect, it's not introducing new risks to Bitcoin. But this becomes clear when you also compare it to other systems. Other systems, in order to introduce programmability earlier than Bitcoin could, had to take technological shortcuts. So for example, Ethereum introduced the smart contract paradigm. And in the Ethereum world, the entire database, the entire virtual machine, all of the code of the software is actually put into the chain itself. This is one of the reasons that Ethereum hasn't been able to scale. But a bigger issue that Ethereum, Solana, Avalanche, and all of these chains have is that because of this, they constantly are going through an upgrade process. They're getting upgraded every 6 months. Their code bases become much, much larger and more complicated. And anyone who's ever used Microsoft Windows knows that when you need to upgrade a system a lot, and when you have a very large code base that no single person in the world could possibly understand, that is where bugs, hacks, exploits hide. And so really the fundamental difference for institutions, but I think for individual users as well, between Bitcoin and everything else, is that Bitcoin's level of reliability has remained consistent and in fact with time has increased, while those of other systems constantly resets every 6 months as they upgrade. And therefore these are much less reliable systems for the long term.
If I'm not mistaken, you mentioned about sovereign project. Could you please elaborate a bit more about it to our audience?
Sure. So Sovereign is an ecosystem of DeFi applications. Among other things, it allows for trading of BTC against stablecoins and other assets. It allows for the issuance of new assets, which are now being, through BOSS, transitioned directly onto the Bitcoin mainnet. So they become native Bitcoin assets. And borrowing and lending. But perhaps the most exciting or intriguing product that was created by Sovereign is the ability to take Bitcoin, lock that Bitcoin up in a programmatic way so that stablecoins can be issued against it, where you know that the value of each stablecoin is exactly $1 because it can always be redeemed for $1 worth of Bitcoin. And so it maintains its peg perfectly over the system was introduced 5 years ago by the sovereign system and has never had a depeg issue. And throughout this period, people have been utilizing the fact that they can use their Bitcoin as collateral basically to leverage their Bitcoin holdings and earn additional yield through the stablecoins. What's happening now is that as we've introduced BOSS, up until now, you had to go and place the BTC collateral into a pool, which effectively was controlled by multisig. Now, what is happening is that you will be able to hold the Bitcoin at your custodian or in your own self-custody, and it will stay in your wallet, but be tied by a smart contract. Basically, a smart contract will say, until you've paid back your loan, even though the Bitcoin is in your wallet, you won't be able to transact it elsewhere. And so this is the absolute lowest degree of potential risk, right? It's absolutely up to you whether or not you pay back that loan. And the Bitcoin will never leave your wallet unless you default on the loan yourself. There is no third party that you need to rely on. And I think this is a quantum leap in terms not just of Bitcoin finance, but of finance more generally.
Thank you, Eden. Since you touched also on multisig and custody. So, Calvin, I have a question for you from a regulatory outlook perspective. Like custodians sit at the crossroad of policy and practice. So, do you expect regulators to converge or diverge in their treatment of Bitcoin reserves versus stablecoin rails? And how will that shape institutional adoption?
Yeah, look, I think looking back my journey to run and to start a custody platform, I had no idea. When I first entered this, I thought this is purely a tech startup, right? Technology, finance, fantastic. I didn't know there was so much regulatory stuff that I'm getting myself into. I had to put on my compliance hat half the time, interesting enough. But we used to say that, when we started in 2018, we say, look, we want to be the institutional digital asset custodian. And what that means is we have to be licensed and compliant. Well, the challenge back then was, where do you get the license? There was no license, right? And we knew that time would come. And now if you look at fast forward, from 2018 to now, 7 years later, obviously right here in Singapore, you had the Payment Service Act since 2019 by the MAS. VARA from Dubai came out about 2 years ago. Hong Kong is now coming out with new regime beyond the exchange side. There's MiCA coming out. There's a Genius Act that's passed in the US. So the short answer is that, well, regulation is already here and it's continuous to come. So from your question earlier is, there is a convergence in terms of regulations being in digital asset space. And I think that convergence is on the principle, right? Meaning transparency, to make sure people are doing the right things, to investor protection, and so forth and so forth. So that is absolute convergence across all regulations around the world. Now, what could be divergent will be kind of a little bit more specific to the asset itself. So for example, Bitcoin is still largely seen as a reserve asset. It's treated as a commodity in the US, for example, and digital asset or digital payment tokens here in Singapore and so forth. So it's treated a little bit differently in a sense that it's treated almost kind of like a speculative asset. So you cannot have regulatory rails such as, stocks and bonds. A little bit closer to that on the capital market side, so to speak. On the stablecoin side, it's being treated as e-money or payment system. So there is a little bit more kind of banking regulation, so to speak. So it talks about reserve, make sure that it's back more than 1-to-1, redeemability, settlement risk, etc. So it's definitely two kind of different kind of regulatory rail versus the Bitcoin side as well as the stablecoin side. But rest assured and understand that regulation is already here and it will continue to come forward in jurisdictions all over the world. Maybe I'll add one last thing, in addition to kind of the regulatory side, is really on the Bitcoin Fi side of things. I think it's fascinating what these gentlemen have built. I'll end it with a couple anecdotes about why Bitcoin Fi, right? If you just purely look at easy numbers, market value of Bitcoin right now is about 2 trillion, and just ballpark on easy number. The DeFi penetration based on this market value is estimated all over the place, but between 1% and 2%. Small we can agree on that. Ethereum now, same thing. You're looking at about 17%, right? Being the king of DeFi, 17. So it doesn't take a genius to guess, well, there's a big delta. There's a big gap between DeFi penetration for Bitcoin. Oh, and guess what? Bitcoin is the largest digital asset and is expected to continue to grow. So what does that mean in terms of the future of digital Bitcoin Fi? Leave that to you guys to think about that.
Okay, you have a very follow-up question. So someone who's coming into this space, so what's your suggestion or what do you recommend from a regulatory or a compliance perspective, Calvin?
So look, I'm not against self-custody and there's nothing wrong with that, by the way, right? There's always like a question like, oh, custody is bad in a kind of an ethos of crypto and self-custody is kind of the true way. You know what? Do whatever you please as you. Right? And I have no problem if you think, self-custody is the way to go. Not a problem. Now, from our story perspective, our focus is on institutional audience. So think about this. Do you think BlackRock will self-custody? Maybe one day. I don't know, right? But for now, it's through licensed counterparties for the time being, right? And that's kind of one of my rhetoric earlier is I do believe in this future of decentralized finance, but the path to decentralized DeFi from an institutional perspective is actually through centralization, the C DeFi path, right? Because now you're looking at Bitcoin, using Bitcoin as kind of the example again. We've been talking about Bitcoin institutional adoption for the longest time. And it wasn't until last January of 2024 that the first spot Bitcoin ETF was approved in the US. So it took a while. It'll take a little bit longer time to kind of really get to the true DeFi side. But in order to kind of get to that side, you have to make sure, do I have the right risk management? Do I have the right operational resiliency? Do I have the right process, the procedure, the backup? You can only achieve that through licensed and regulated counterparty first, such as a custodian. And then the innovation can really take off from there.
Yeah, you mentioned about ETF. Sorry, I want to want to ask you another question, a follow-up. Like you mentioned, 2024 ETF happened, and then we saw other countries following. Even Hong Kong did it. So when do you see Singapore going that route?
It's a tough question. So I think it will take a little bit of time. I think Singapore traditionally is, a very, strong regulator in the MAS, but also takes a little bit more conservative approach. And also in terms of kind of digital payment products, it's a little bit slower than, and maybe sometimes they take a more followers approach for, especially looking at Hong Kong, right? In a region, usually Singapore, Hong Kong, they kind of go back to back. But there's a lot of wealth management, family offices here in Singapore. So the focus is more wealth management as opposed to capital markets versus that of, Hong Kong. So as more and more demand from private wealth, family offices, high-net individuals, they're getting more, demand more and more exposure to digital assets or digital payment tokens. I fully expect that to be soon, but maybe not tomorrow. And this could be the case for DATs, by the way. I know you want to talk about, but same for DATs. I'm not holding my breath for DAT in Singapore yet.
Thank you, Kelvin. Let's move on to you. So for stablecoins to be sustainable, their backing models matter. So what structures, fiat, Bitcoin, or mixed reserve, do you believe will define the next generation of stablecoins, and why?
There is no clear answer to that. So today we have the leader, which is USDT, and then USDC, and so what we see is that this is not a market of a winner takes all like it happens in other markets. Is that we will see stablecoins for different use cases, different approaches, given stablecoins backed by fiat, stablecoins backed by crypto assets. So we think that there will be use cases for every, for every option on every user. So there is no a clear answer to which is the best way to back a stablecoin. So there are different options. Which is very interesting is that what's going on with the regulation and the stablecoin. So we see, of course, it's super interesting what happened in the US with Trump pushing forward all the crypto assets, regulation in favor of crypto. That's super interesting. And on the contrary, what we had in Europe, it's a total disaster. So what happens in Europe is, with over-regulation is killing innovation. And in Europe, for instance, so we don't want, they don't say that, but if you read the MiCA regulation is, we don't want the private stablecoins to succeed, so we're going to set strong limitations so that stablecoins are not popular, they don't grow, and then we can push our CBDC, which is a total disaster. But what's going on in the end of the day, so it's really a big fuck up for the euro and for Europe is, as I said, 99.9% of the stablecoin market is in non-US dollar. 99% is in US dollar stablecoins. Euros are non-existent. Euro stablecoins, they don't exist, and that's a total disaster because we understand how important it is. The future of the currencies is in stablecoins. So if a region, a country wants their currency to be successful, so in the case of the US dollar, like the world's currency, is going to happen because the US understood how important stablecoins are. And in Europe, there are like shooting on the field, on the foot. So because the euro is gonna, unfortunately, as a European, so the euro is gonna keep being irrelevant if they don't push it, and if they don't make private stablecoins succeed, and they don't help private stablecoins.
I have a follow-up question. I completely agree with you when it comes to CBDC. We share the same sentiments. I know the regulation space in Europe as well. I mean, compared to what Trump did, he passed on the executive orders, he did Genius Act, wonderful thing. I don't know in detail depth, like how does that work in Europe, but are you optimistic from a regulatory standpoint when it comes to your continent? Or like how is the overall sentiment?
I don't want to say this because as a European, I love Europe and I want Europe to succeed. But that's why I spend most of my time in Asia because because obviously everything is going on in Asia or in the US, and unfortunately I'm a bit pessimistic about Europe. I wouldn't say this in a European conference because
That's very
but
much.
here I can say it openly. I'm not optimistic. Europe is not doing things properly. The regulation is really bad, and I don't know what's going to happen. But for now, Europe is killing innovation, and crypto companies are flying out of Europe, and all the crypto companies are, I mean, all over the world. But people are leaving Europe, and innovation is leaving Europe.
You know, if I could just add to that, if you think back to 2016, 2017, the absolute capital of Ethereum innovation and the dApp world was Berlin. The absolute capital of hardware wallets and solutions was Paris. The absolute capital of TradFi and structured products, custody solutions was London. Europe was firing on all cylinders when it came to crypto. In fact, I was living in San Francisco. I was living in Silicon Valley. I moved to Europe because that is where the action was happening. And a big part of that was the US regulatory environment became so hostile to crypto that it pushed everything out to Europe and East Asia. What has happened since has been a complete reversal. The United States is now open, and Europe have done everything they can to make sure that Europe remains a museum, and that at most they're just cleaning the tables and moving the chairs around, but not making any fundamental changes. So I see it as well, and we see it on the ground.
So Eden, what went wrong? Like Europe was considered at that point of time the most mature ecosystem when it came to when it comes to such ecosystem. So what are the three things that you think went wrong?
Well, I'll tell you, it's not one thing, or it is one thing. It's a regulatory environment which became increasingly difficult. Mika, for example, was introduced this year, but we've been talking about it for years. One of the things that I did was I helped create the regulatory sandbox in London. And my remittance company at the time, Epiphyte, was the first company in the regulatory sandbox. The regulatory sandbox was basically regulatory safe harbor for fintech and crypto startups. It was then copied in Hong Kong. It was copied in Singapore. It was copied in Israel and in Russia. And I flew to different places to try and explain what we had done. And then that was sort of the peak. That was 2000. That was between 2014 and 2016. That was the peak of London and Europe being the home of crypto. Since then, the regulatory sandbox has been defanged. There is no safe harbor. No banks will work with companies that are in the regulatory sandbox. Taxation has risen. The non-dom status that you could get for taxation in the UK has been removed. Mika has been introduced. Other KYC requirements have been introduced. And so it's just become increasingly difficult. People have been losing their bank accounts in Europe and finding it easier and easier to open them up in Singapore, in Hong Kong, and today even in the United States.
Thank you. Let's move on to Luke now. So, Bitcoin is increasingly treated as a reserve asset by both individuals and institutions. So, how does SatLayer design reinforce Bitcoin's roles as a rising global reserve asset? And do you see this ultimately competing with or complementing traditional reserve instruments like treasuries?
Yeah, I think I'm sorry. I think shifting gears for a second on the earlier topic around kind of Bitcoin becoming the reserve asset, right? I think there's just so much work that can be done, right? Because in many ways we're starting with, it's like in TradFi sense, if you rewind to when we back when the world was on the gold standard, right? I think now with Bitcoin being established digital gold, right? People want to do more things with it, and so let's put it to use. Let's make it productive. And so in terms of what SatLayer do at our core, right, in terms of restaking is really being able to make an asset programmable collateral based on on-chain and off-chain events. And so if you think about really the kind of now the mass adoption wave that we are on, especially with Bitcoin, right? It can't just be that something is programmable that's fully on-chain, right? Because a lot of things are not on-chain, right? If you think about, kind of the CDFI side of things, custody, but even a lot of traditional markets, right, are not on chain. If you think about insurance, right, a lot of insurance coverage and getting coverage, for example, for natural disasters, not on chain. And so what we're really doing is building the infrastructure and the underlying plumbing so that Bitcoin can become the collateral asset that's programmable based on both on-chain and off-chain events. And so this is important, right, for like Bitcoin-backed insurance, as I mentioned, so that you could essentially rebuild insurance companies on-chain, right? And it's, for those that are familiar, right, the biggest insurance companies in the world are massive. They individually custody $1 trillion each, right? Berkshire Hathaway, Alliance, Ping An, China Life. And they're also generating 8 to 20% yield, right, in terms of ROE. And so these are amazing businesses that can literally size-wise take the majority of Bitcoin. And so what we're doing is rebuilding that rebuilding the insurance company on chain, but being able to actually insure on-chain, off-chain events. In addition, I think it's really about ultimately rebuilding the financial system on chain, right? So that means banks, that means lending, that means short-term loans, secure loans, repo, liquidity flow. And so that's another big use case for us, is to really kind of rebuild these financial primitives in, I think, some of the most interesting use cases. So we're working with Aether, who does a lot of AI infrastructure-based loans, right, on a a repo facility, essentially, right? A bridge loan for some of their borrowers that are deploying GPUs in data centers. And so this is, a bridge loan backed by Bitcoin, where the yield is the borrower is paying this premium, right, to be able to actually have more time to offload these assets to be able to repay their loan. So this is where we kind of generate the real yield. And this is one of, I think, many use cases that, we have in the works that deliver real Bitcoin yield to end users in immediately.
Thank you. Thank you, Luke. So since we are running out of time, so any final thoughts? Let's start with Edan.
Look, we're at the beginning of Singapore Week, Singapore Crypto Week. So what that means is we all ahead of us have a week of a lot of bullshit. And I've been coming to these conferences now for many years, and it can be easy because there is so much nonsense in our industry to miss the signal for the noise. So I think sometimes it's worthwhile to remind people, people sometimes get depressed. I don't know what I'm doing in this industry anymore. Everything seems like a scam. It's all nonsense. Over the last 15 years, we have gone from zero to creating a entirely new form of asset, a digital commodity. We've created property rights which exist anywhere in the world and are not dependent on any government. We've created an industry worth more than $3 trillion. We've created free and sometimes even private cross-border transactions, which cannot be monitored or stopped by anyone. We're seeing increasing use of BTC as a way for people to build wealth and maintain wealth for themselves for long periods of time, and stablecoins as a way for them to transact between themselves in any place in the world at low cost and instantaneously. And we've seen a huge industry now emerge of players like custodians, like the systems that we're building, that are allowing this to expand beyond just early adopter retail into the institutional space, so that we are now seeing the largest corporates, financial institutions, and governments in the world adopting this ecosystem that we've built. So yes, there's a lot of nonsense out there, but the signal is ginormous. The rate of improvement, the rate of growth is astounding. There has never been a faster growing economy in the world, right? Effectively, this $3 trillion economy now is larger than the economy of most single countries, and will soon probably be the largest economy in the world, because it is the digital economy. It is the free economy. So I think it's a very exciting and important thing that we're doing here, right? Fundamentally building this idea of property rights available to everyone, free market access that everyone in the world can participate in. And so I'll just sort of end with this. My view is that what we're seeing now is a phase shift. We're moving from a market which has been mostly speculative into a market which is going to more and more eat up, sort of, in the same way that software has eaten the world, crypto is now eating finance. And for the next 10 years, what we're going to see is Bitcoin, stablecoins, and to a lesser degree, I think, the rest of crypto essentially consume the financial world, take it from being based on specific nations and turn it into a truly global, free, and open economy.
Thank you, Eden. I mean, I just love the way you have the guts to call spade a spade. Commendable. Let's move on to Liu. Any final thoughts?
Yeah, not an easy one to follow, certainly, but I think definitely echo a lot of the sentiments, right? And I think when you think about the time that we're currently in, right, it's a time of change and honestly chaos. And this is where, in terms of, right, like the global order is changing, right? I think especially here, right, and this is something I've been saying for a while, separate from Europe, I think even the US, I think, is starting to struggle as the world leader and as the leading global reserve currency, right? Adding on to that, you have AI that is just displacing a significant amount of white-collar, middle-class jobs, right, and will continue to do so at an increasing pace, right? And so in this all backdrop, I think you have, Bitcoin and crypto, that's, as Eden kind of well put it, right? I think it is the future of finance, because if you look at, right, whether it's stable coins, whether it's Bitcoin, from just a pure product perspective, something like, finance and currency is all about liquidity, right? And so you have traditional finance that is Monday through Friday, right? In terms of settlement, one day maybe, or like 3 days or even longer, right? That's very much last century at this point, right? You have crypto that is 24/7, 365, no holiday, right? Full confirmation within minutes or seconds. That is just clearly the future from a product and user perspective, right? And then you have Bitcoin, right? This global reserve asset at this point that is not tied to any country, right? In a time when the global power order is shifting. So it's, I think, a no-brainer that Bitcoin is already 1 trillion, on track to become much, much bigger than this. And so I think, echoing sentiment, I think very exciting times ahead, right? There's always going to be noise, right, in a kind of fast-moving space, certainly such as crypto, right? But I think we are now seeing a lot of real adoption and real value being built.
Thank you. Kelvin, over to you now.
Yeah, thanks. I mean, literally, literally just echoing some points here. I mean, what a great time to be in the industry. right? I mean, I used to say, oh, to potential investors, we're building the bridge, the regular bridge from traditional to crypto. Why? Is because, well, I'm trying to raise money to keep the company going, right? Now, did I really believe that they would come in? Yeah, probably, maybe, but I wasn't 100% sure, to be honest, right? But now, if you look at where we are today, we can say it with 100% certainty that institutional investors and clients are in this industry and building and thriving. Like, we can say that, right, with a straight face, because it's obviously true. And I think the future, and we're just getting started, right? The future, if you think about just finance, the future of capital markets will all be on chain. We're nowhere near there yet. I think the next panel is on RWA. They can certainly talk a little bit more about that, but that's the future. We're not there yet. We've already seen great movements to get to where we are, yet we're just getting started. So forget the noise. I mean, yeah, sometimes you can think about your meme trading and all that fun stuff. I'm sure there are other conferences for that. No problem. Enjoy yourselves. Be responsible. But if you're here for the long term, what a great time to be building.
When I attended my first Bitcoin meetup in San Francisco, year 2012, I could have never imagined that we would be what we are today. Or when I started my first crypto company in 2016, so it was impossible to guess. So what we thought at that time, maybe 2017, is I told my friends, look, one day every bank is gonna offer Bitcoin to their customers, and they were like, that's impossible, and it's happening today. One day, the big CEOs of the traditional financial institutions are going to embrace crypto. So it's happening today with BlackRock and the likes. So we are now in a moment that probably we dreamed about, and exactly, it's a great time to be here in this industry, and we are in the right time, the right moment to catch the wave and to grow with this exponential growth that we are expecting in the crypto industry. So where we understand that the ones we are here at the conference, we saw the future, we see the future, and we are where we have to be to create the new financial system.
I mean, I completely agree. And you mentioned about 2016. And in fact, anybody in the audience who's just ventured into this space, trust me, it's still early. It has just started, as Kelvin also mentioned. So yeah, okay. Since we are running out of time, so that's a wrap. Thank you, panelists, for your vision, for your thoughts. And thank you, audience. And let's continue this conversation beyond this stage. Thank you, everyone.